Welcome back. I'm Justina from Practice Test Academy. This is part 2 of our ACCA BT Corporate Governance series with our experienced tutor, Anthony Walpert. This time, SOX, so Sarbanes-Oxley, versus UK codes, who's who on the board, and why audit and remuneration committees matter. Over to you, Anthony.
So, with regards to corporate governance and the implementation of procedures to ensure that companies and organizations manage their affairs in ways that are more sustainable, the United States, for example, has introduced the SOX Act, which is fairly codified. In other words, it sets out rules and regulations in fair detail. This mirrors the way that the United States manages, for example, its tax regime. It's very codified, as it does its auditing and corporate law environment. It's just one way of doing it, and they codify very specifically what different companies and organizations need to do. So generally speaking, they're in line with most of the other thinking that is developed over the rest of the world. And what it does, in a sense, is it asks for independent boards of companies to be established with remuneration committees being made up of people that are not operational. It asks for the directors and the operating directors, the main agents, to certify financial statements being accurate. So it places on them a responsibility that they make positive statements that no fraud has occurred to their knowledge. And it asks for larger companies to form audit committees and relies on independent directors with the requisite skills to be put in place to manage larger companies from a corporate governance point of view. In the UK, a slightly different approach has been taken in that the different aspects of corporate governance have been studied over the years and dealt with in different approaches and different documents, but which all become combined at a later stage to form a composite approach on the issue of corporate governance. The different committees and reports that have been drawn up are listed in your notes. So this is an approach which is not codified in the sense that the Americans put down specific rules. It follows more an English law format where the law generates itself and it is formatted through court and government findings and edicts. But in essence, the same approach is followed in that it's asking for non-executive directors of larger companies to make sure that the executive directors are following best practice. It separates the processes of audit committees, of remuneration committees from the running. So it brings those out into the public domain or to the domain of the stakeholder and provides a greater deal of independence in the decision, the covering of the company. So had these recommendations been followed strictly, large problems at companies such as, for example, Steinhoff, which was a recent corporate governance failure, a massive company spanning many different countries, which involved both fraudulent representation and also just gross negligence in certain instances, but even incorporated in some instances the auditors not being careful enough or taking enough time to understand certain of the complex transactions that were being claimed. So these are the types of large-scale corporate failures that are being encouraged to be avoided by a tightening up of a corporate governance environment. The gist of most of the corporate governance information, whether it's the American or the British, and certainly in other Western countries that are following the same suite, is that it's asking for a company which is a large company, a large organization, to see an independent nature of a board that manages the company as a start. So in many instances, the chairperson, who would be the leader of the board, and let's just go back to what a board would actually do. A board would be made up of individuals who have requisite skills and responsibilities, and it's their responsibility to guide the company forward, to make sure that it is in line with all of the legalities that are required of it, to make sure that it is following best practice in all aspects, and also to take strategic decisions with regards to the actual business development, which was discussed earlier in the videos. So a director is somebody who is appointed onto a board. And we've also discussed that those directors are asked and required to act in a fiduciary manner. So what that means is that the most important thing for them to do at any stage is to hold their position of directorship above any of their other interests, any of their personal interests. So the directorship will be required to make sure that the company is benefiting to the utmost, which then leads on to benefit for the shareholders, and holding in balance the complexities, for example, of the conflicts between the external parties, the internal parties, the environment, etc. They're required to incorporate all of these into their decision-making, but to avoid making decisions based on their own personal preferences or needs. So a director is somebody who's going to be appointed onto a board, and generally speaking, they're asking the board to be made up and to be represented by a chairperson. The larger companies, these corporate governance acts are saying that they wish them to be external to the company, non-executive, and an external party. They may hold small amounts of shares, but certainly not enough shares to sway any decision-making from a voting point of view. They're also asking the rest of the board to have a fair number of non-executive directors, so directors that are not involved in the everyday running of the company, that may own smaller amounts of shares, but they disclose these so that it's perfectly upfront, and they stand alongside all of the other stakeholders and shareholders in their interests, but they do not run the company on a daily basis. So they stand separate, and they watch for the company to be looked after in an independent way. You very often find that the board of directors will be represented. There will be representation from executive directors, such as chief executive officers, chief financial officers, and often chief marketing or sales officers. And this is so that the board is fully informed of the on-the-ground activities of the company. Certainly it's a chief executive and a chief financial officer to be on the board so that they can report to the other directors the detail of the financials and of the operations. But from the marketing point of view, if strategy is required into the future, as it always is, the marketing and the directorship of that division would very often be represented as well. But what the corporate governance environment is asking is that the executive directors, the people running the company, are not responsible for making high-level decisions, certainly that affect themselves. For example, their remuneration. It's asking for external parties external directors to be offering what they feel that executive directors should be paid, and taking that out of the hands of the executive. And it's also asking for an audit committee. So in other words, they don't want a chief executive, they don't want a chief financial officer being in charge of the final audit committee. They want that to be done independently so that the auditors are able to speak freely and to comment as they see fit without the fear of repercussion from the operating side of the business. So just to swing back a little bit, the reason or the purpose of a board of direction is, it's manifold, but it really is at high level. So it deals with things like mergers, acquisitions, and disposal of the major assets, capital projects, but it also decides on direction of the company, into which avenues it should be taking. And it also has the responsibility for making sure that the company is in context with the rules and regulations in which the organization operates. So in terms of corporate governance and the different roles that they're asking the parties to play, when a chairperson is appointed to a board, they expect a chairperson to be a leader of a board. They expect them to be fair and just and to manage both sides of any conflict neutrally. They also are responsible for running the process of the board. So they're asking the chair to drive the meetings, to make sure that if there are additional responsibilities which need to be delegated or committees which need to be set up, it would be a chair's role to suggest that and to ensure that those committees are put into place with the requisite and the appropriate people filling those roles. Also, very often what will happen is if there is a voting notion within a board of directors, so if votes are required to be a majority vote, very often the chairperson is given a swing vote, which means that if yeas and nays are in a perfectly equal position, a chair is able to make the final decision rather than have the company remain in a stalemate position. Besides the chairperson, the role of a chief executive officer, who is then responsible for the day-to-day running of the meeting, would be responding and reporting into a board. It's his duty to actually implement at the highest level the instructions from a board of directors, and he would manage all of the operations on a day-to-day basis. As you saw earlier, they're being asked now in terms of many legislations to state categorically that the affairs within the companies are being done according to corporate governance requirements. There have been enough instances where the chief executive officers have been the main protagonists of very severe problems within companies, and the corporate governance environment is asking the boards and the chief executive to operate in a much more open and transparent manner to ensure that these matters don't replicate. One of the directors that would be on the board, so it might be an operational or a non-operational executive, would fill the role of a chief administrative officer. So when we have large organizations that require consistent and complicated processes to be complied with, such as tax returns, such as reports back on the various aspects of the business, be it environmental or provisions towards employment requirements, one party is normally appointed in that position as a company secretary, and it's their responsibility to make sure that all of the requisite documentation, the legal documentation for the company, are kept in order, that minutes are kept of all meetings, that all submissions made on behalf of the company towards the relevant authorities are done timelessly and done correctly. So it's a very important role, especially in the larger organizations, and one which corporate governance infrastructure is requiring at this stage. Just touching on board members again, we've mentioned it before. Corporate governance laws require that board members are skilled and play some part in the role, so it's to avoid instances where boards may be loaded with people that are not skilled and may have voting swing or voting capacity to lead the company for some reason other than the company's best interest. So it really is asking of non-executive and executive directors that they must be skilled, they must have an appropriate input into the board and be able to take responsibility in certain instances for outcomes such as specific committees which may be set up to drive particular projects within the company. What we see is that board members, as we discussed, can be internally from your executive, or otherwise they may be made up of non-executive directors. So a non-executive director would be somebody completely from the outside of the company, and very often what companies do or organizations do is that they hire quite diversely in this sense. So you might have a manufacturing and industrial organization. In some instances, it might be interesting to bring on somebody highly skilled in the environmental world, or, for example, in the tea world, which is not automatically and immediately obvious as to why they would be on a board of an industrial organization. But the crossover of the skills is very often quite important and quite useful, but they must also have some kind of reference to the business at hand. These are normally limited time frame appointments, and what you're looking for is people who would remain neutral in the event of conflict, but be looking for the best interest of the company and the organization, but within balance with the outside environment and the existing laws and etc. So one of the main areas that has also been dealt with in corporate governance are the remuneration and audit committees, and this is because it's one of the areas that the greatest amount of abuse has taken place in the past. With regards to remuneration committees, the notion that the people working within a company would set their own standards of their own remuneration has become frowned upon. It's happened in many instances in the past. For example, there have been instances in airline companies where chief executive officers have been responsible for remuneration decisions and have awarded themselves massive bonuses based on actions taken by the company that in the long run actually bear against the company, such as, for example, sale of fleets and entering into sale and leaseback agreements where actually in that particular company holding onto the assets might have been the better decision, notwithstanding the fact that in any event the bonuses, etc., were calculated on the quantum of the sale, which are ginormous when dealing with aircraft, and quite out of proportion in a sense. It's not, the risk certainly was not taken by the chief executive officers and the directors. That was held by the shareholders. So to be remunerated for simply setting something at a profit is unusual, and this is what these laws are trying to avoid. So it's asking with remuneration committees that you have people external to the business. It is sometimes seen that one person within the company, so if there's, for example, a human resources director, or it might be a chief executive or a chief financial officer, will also sit on the board because the knowledge of the comparative salaries and the performance levels is known. But they should be in a position where they are outvoted by or managed by the external parties. In other words, the external parties are able to have sway as to the decisions made. The audit committees are also asking for to be set up primarily by non-executive directors. It is usual, though, for example, a chief financial officer to also sit on an audit committee, but again, to have a predominant external non-executive influence so that decisions are made in that basis and not led via the management of the company. So this committee would be responsible for managing both your internal controls and the scopes of audits and any requirements for, say, for example, changes of audits or for major reporting conflicts or adjustments to be made. It needs to come through the audit committee and not just be made on an executive level at the operating level. So have a look at this. It's quite a comprehensive table and will give you a good idea of what the remuneration and audit committees are asked to provide. So what we're also seeing now is that the reporting standards of the different stock exchanges around the world, and as are prescribed in many of the accounting bodies in different countries, the above information, the processes and the implementation of these requirements into these bigger companies is required to actually be reported on and to be stated into the public, into the domain of the shareholders, and available for the shareholders at shareholders meetings so that they can understand what management is doing, how they're coping with the requirements of corporate governance, and are able to assess where there may be weaknesses or shortfalls in these policies. In many instances, the statements are predetermined, and it requires the directorship and the board to simply sign that as an acknowledgement. And in other instances, boards are required to positively produce documents which describe what the processes are. So I hope this video has been helpful just to give an understanding of the overarching concept of corporate governance and corporate governance management. And in the next video in this chapter, we will start talking about social responsibility within organizations and the implementation and the reporting.